Over the last 15 years, the general stock market has returned an average of 12% per year. At this 12% rate of return, if you were to start at 18, investing $100 per month until you were 65, you would end up with nearly $3 million from only a $50,000 investment. Hi, my name's Hiro. I'm 17 years old, and I use this channel to share business and personal finance advice. In this video, I'll show you a step-by-step guide on how to invest in stocks as a teenager and exactly how I built my own portfolio at just 17 years old. Step 1, you should use a commission-free platform. Most big banks and primary investment brokerages tend to charge a service fee based on every transaction you make. So every time you buy stocks, they'll charge you, say, a $10 commission. If you're buying $10, $20, $30,000 worth of stocks at one time, then a $10 or $15 commission isn't really a big deal. But if you're a teenager investing your minimum wage McDonald's pay, then $10 per trade is a lot of money because you might only be buying $100 or $200 worth of stocks at one time. This means you want to find a platform that doesn't charge you on a per transaction basis. Platforms like Wealthsimple, Questrade, Webull, and Robinhood do not charge on a per transaction basis. I'm in Canada, and Wealthsimple is the platform that I use. Instead of charging me $10 per trade, it charges me a percentage of my entire portfolio every year. So as someone who's making small trades and only has a little bit of money in my account, this is a far better option than paying $10 or $15 for every trade that I make. Step 2. Open a tax-advantaged account. If you just open a regular investing account and start buying stocks, you will be hammered with taxes and taxes and taxes. But you do have an option to open tax-free investment account. These accounts allow you to buy stocks and not pay taxes on the profit that you make from your stocks. In Canada, you can use a TFSA or a tax-free savings account. In the States, Roth IRAs are popular, and in the UK, you can use a stocks and shares ISA. Step 3. Choosing your stocks. This is a very, very complicated topic, and I could spend hours and hours talking to you about how to analyze stocks. And there are way smarter people out there who could spend even more hours telling you how to analyze stocks. The truth is, most people shouldn't really be trying to do that. As I said at the beginning of the video, the general stock market has gained 12% per year over the last 15 years. The vast majority of investors cannot beat this. I hate to break it to you, but you are not smarter than the market. 90% of investors will be better off investing in exchange-traded funds, index funds, and mutual funds, rather than trying to pick their own individual stocks. Now, I know that might sound strange. Exchange-traded funds, mutual funds, exchange-traded funds, or ETFs, and index funds are baskets containing a large number of stocks. For example, the S&P 500 is an index fund, which is a collection of the 500 largest companies in the US. You are able to go onto your investment brokerage and buy a share of the S&P 500. Or more accurately, you can buy an ETF, which tracks the S&P 500. I know that sounds a little complicated, but think about it this way. This ETF with the ticker SPY is an exchange-traded fund which follows the S&P 500. This means that if you buy one share of SPY, you're essentially buying small pieces of the 500 largest companies in the US. This means if the 500 companies go up in value as a whole, then your investment also goes up in value. The advantage of this is that if any one single company crashes, your investment is still fairly safe and won't be terribly affected because you have 499 other companies still going well. So ETFs or index funds are just a collection of many, many stocks. A mutual fund is a group of stocks which are managed by a professional investor. You're essentially giving a professional investor your money and they invest it for you. For the vast majority of investors, mutual funds, index funds, and ETFs will be the way to go because, unfortunately, most investors are simply not good enough to beat the market. Take a look at this graph, which is a little bit old, but compares the average rate of return for investors and the S&P 500. As you can see, the S&P 500 makes way more money than the average investor. But if you would like to take on a higher risk strategy, then go ahead, buy some individual stocks that you analyze. I also buy some individual stocks, but the ETFs that I own perform way better than the individual stocks that I choose. So keep that in mind when you're deciding what to buy. Step 4, focus on time in the market. If you've never heard of compound interest, it's the concept of gaining interest on previous interest that you earned. I know that might sound a little weird, but let me break it down. Let's go back to our S&P 500 example, where you're making 12% return per year. Say I put $100 into the S&P 500, and a year later, I have $112. Now, for the next year, that new 12% return is not only going on my initial $100, but is also going on the $12 I made from the year before. So instead of having only $124, I have $125.44. Now I know that doesn't sound like a big difference, but over many, many decades and thousands of dollars being accumulated, this adds up. Maybe you remember the example I gave at the very beginning of the video and how if you started at age 18, you would have $3 million by the time you're 65. If you waited just 10 years and started when you're 28 instead of 18, instead of having $3 million, you would have only $800,000 by the time you turn 65. The vast majority of that money that you're making happens in those last 10 years because the money builds on top of itself. Start putting money in as soon as you can and leave it there. Don't take your money out of stocks to buy stupid stuff that you don't need. Leave it in for as long as possible and take it out when you're ready to retire. There are plenty more videos on their way about how to maximize your profits in your investments. But for now, you know what you need to know to get started. I believe in you. Go get rich.